Welcome back to 22 Minutes in Lending. I'm your host, Vince Passione, and today we're joined by James Chemplavil, co-founder and CEO of Salus. After more than 16 years in investment banking, James set out to solve a challenge he saw firsthand: how hardworking people are often denied access to small but critical loans. That mission led to the creation of Salus, a digital underwriting platform helping credit unions and community lenders extend microloans using alternative data. We're excited to dive into his story, his vision for Salus, and how technology is reshaping lending for the better. Welcome to the podcast, James.
No, thanks for having me. Appreciate it.
Awesome. So listen, I took a look at LinkedIn. You're one of those unique people, right? You've got basically two backgrounds, one at Barings, and the other at Salus. So I always love to start out with hearing the founder's story. So what was your why? What got you from Barings to Salus?
The story is probably not a typical one. I was working, as you mentioned, for 16 years at a company called Barings, underwriting high risk corporate debt on the investment management side. Loved my job, enjoyed it, enjoyed the people. And what got me to sales was not kind of a typical path. I've got two boys. They are now 10 and 12 years old. But when my oldest was about 18 months old, he was in a daycare down the street from our house. And one day we found out that his favorite teacher at the daycare was leaving, which in Charlotte usually means you got a job at one of the private schools or one of the public schools, so you're going to get paid more. It's a better job. So I went to congratulate her, find out where she's going next, wish her well. And what she told me was not what I expected at all. It turns out that she had gotten into a car wreck. And even though she had car insurance, she couldn't afford the deductible that it took to actually get that car fixed. So now, without her car, she tried to take the bus to get to work, which in Charlotte is not necessarily reliable. And after about a week of being late to work, the school told her, look, as much as we love having you here, if you can't be here on time, you can't work here. So it turns out she wasn't leaving a job that she loved, she was losing a job that she loved. And it wasn't due to anything she had done as an employee, it was really due to the fact that she couldn't borrow money when she really needed to. And as someone who came from a totally different part of finance, I frankly didn't understand. I thought this is why banks and credit unions exist. A young woman with a steady income that needs to borrow money. This is why we have banks and credit unions. And what I found out was for nearly half of adults in the US that don't have a prime credit score, that's just not how the system works. And so that was the start of me figuring out a way to try to change that for people like Wendy.
So I think I know the answer to this, but why credit unions? Why not look at other balance sheets? I mean, after Barings, you had the connection. So what was unique about credit unions that said this was a good place for you to sort of invest with Salus?
Yeah, so there's a couple of reasons that we focus on credit unions. The first one that we focused on was the fact that a lot of credit unions are focused on serving members of the community where they operate. Even in the community banking sector, you may see a little bit more of a tilt towards the local businesses and the small businesses in the area relative to credit unions that are primarily focused on serving the members of that community. The second thing that we saw is an opportunity to work collaboratively. The credit union movement, and they call it a movement, is just that. It is not necessarily the banking world of people competing for every single dollar. It's a collaborative, collegial environment. A credit union that's using our product is just as likely to recommend it to a credit union down the street because they're trying to help everyone in their community and they see credit union peers as part of their community. And the last thing that we really saw was there was an opportunity from a technological perspective. A lot of credit unions may not have the same tech resources from a financial or human capital perspective, and being able to collaborate with them and bring them a technological solution was something that benefited them and benefited us at the same time.
Great. So now you're an underwriter by training. You underwrote big corporate debt. So lots of data, you use data all the time. What was the data that you saw that convinced you that microloans were A, necessary, and B, it was really a viable business opportunity? Because there's not much money made on one of these loans, right? I mean, this is average balance is about $500. And, if you look at the revenue on these loans for a credit union, it's probably less than $200. So give us some of the background there.
Yeah, so the original idea around this actually came from my background in underwriting on the corporate side. And I'm going to date myself a little bit, but if you go back to the great financial crisis of 2008, 2009, one of the things that we saw as corporate underwriters was that You can have asset values, you can have appraisals, you can have estimates of what an asset is worth.
Mhm.
But when it comes down to actually whether a company would survive and avoid Chapter 11 reorganization, what tended to matter is how much cash was coming in the door versus how much cash was going out the door. Cash flow was king. And that concept actually ports over really well to people who aren't benefiting from traditionally high credit scores. And that is to say that for people that don't have a prime credit score, looking at cash flow underwriting, looking at cash in versus cash out can be a much stronger predictor of someone's ability to repay and someone's willingness to repay than kind of traditional metrics may point you. And that may have to do with the underlying score, but it may also have to do with the underlying age of the person that is applying. A lot of people that don't have traditionally high credit scores, they tend to be younger. They tend to be earlier on in their career path, so they just haven't built up enough history in the proverbial system that would generate the credit score that they're going to grow into.
Now, look, makes sense, right? We're in the education lending space. We put credit unions in the education lending space, and we encounter thin files all the time, right? Different demographic, but trying to solve some of the same problems. So James, let's jump into the product. So the actual loan itself. So uh, talk to me about the loan, how it's structured, and let's also talk about some of the automation that goes into it. Because clearly, your business has to be about really reducing the cost to originate a loan that today would really generate, it generates revenue, but we need to be careful about the expense side.
No, 100%. So the microloan product that we offer today is a fully automated, digitally underwritten product for an institution to offer to its members or its consumers. 50 to $1,000. The issue that you run into is twofold when you're trying to administer a loan program like this. The first is about 94, 95% of the people that want this loan, that are going to apply for this loan, don't have a prime credit score. So if you're looking through a traditional lens, a lot of people are going to fall out of the credit box immediately. And they're not necessarily people that you want to fall out of that credit box, because in our data, what we found is about 94, 95% of people that repay that microloan on time, they didn't have a prime credit score when they applied. So you're actually removing people that would be good prospects for that loan. The second reason is something that I think most of us understand intuitively. It doesn't matter how big a loan is when you're processing it, you still have to take the same steps of
Right.
viewing the application, making sure they meet the eligibility criteria, posting that loan to your core processor, dispersing the funds. And that time in staff cost can be debilitating to the unit economics of something like a microloan. So we're really attacking the problem from two places to make it palatable for credit unions, which is we're giving you an underwriting tool that allows you to look beyond credit score to identify creditworthy people that maybe don't have the scores that reflect it yet. And we're also automating steps so that you don't spend 30 to 45 minutes and 3 to 4 staff members' time when they could be working on a larger, more profitable loan for your credit union.
So, James, based on the product and what you just discussed, who's the ideal credit union for you, the credit union that really needs the Salus product?
So there's really kind of two buckets for credit unions that need the Salus microloan and earned wage access product. The first bucket is a credit union that is actively considering how are we going to attract younger members to our credit union and build a primary financial institution relationship for them. If you're looking for innovative products that are going to attract and retain Gen Z members, that's use case one for Salus microloans. Use case two is actually for credit unions that are community impact focused, that are looking to make an impact and save their members money to improve their lives. We know from our data the CDFI eligibility, low income designated eligibility, even CRA eligibility of microloan borrowers relative to the population. This is a fantastic product to provide deeper relationships and activity with those particular members. So for credit unions that are focused on community impact and want tools that can reach those members in an efficient way, Salus microloans and earned wage access are a great tool for that goal.
Got it. So back to product, I also saw on the website Sentinel.
Yep.
It looks like that, from what I could tell, it tracks the financial position of the credit union's loan portfolio and has this stress score. So let's unpack that a little bit. Why don't we talk about that part of the product offering?
Yeah, I think one of the things that I have loved about working on Salus is the fact that the conversations that we get to have with credit unions precipitate our product roadmap for us. And so one of the things that we saw when we talked with credit unions was they had members that were already using emergency microloans. They were just getting them from payday lenders, they were getting them from fintechs, they were getting them from a lot of sources outside of the credit union. And the conversation went like this. Well, what if we could get to them before they use those solutions? If
Right.
only they knew that we already had a microloan that they could be using. Maybe they could use ours instead of having to go to a more expensive, more predatory option. And that was really the genesis of Sentinel, which is predictive analytics for your members. Because what tends to happen with a lot of credit unions is they have an amazing suite of services. They have microloans. They may have skip a pay on an existing loan, but members don't know about that service. And the issue for a lot of members is if you don't get them that service, if you don't show it to them in the moment that they need it, they're going to go find something else. And so Sentinel is designed to look at a credit union's membership and say, for this person who may be entering financial stress, what is the way that we can offer them something that they can use in the moment that they need it so that they can stay on their path to financial wellness?
Now, James, are you just looking at the data the credit union has, or are you like a method where using someone like Method where you can put a telephone number and Method will go out and look at all the different loans that someone might have, not just what's residing at the credit union?
So we are starting with just looking at credit union data because there is actually a wealth of information just embedded in credit union data that they have with their members. When a member has a primary financial institution relationship with a credit union, there is a wealth of information that you have about what's happening in that member's life in the data that you have with that member. So when you have a member that is going through a situation in life, sometimes their financial data may reflect that situation before they come to you and ask for help.
Mhm.
And what Sentinel allows you to do is it allows member service representatives, it allows loan operations staff, it allows collection staff to be a little bit sharper and be a little bit more knowledgeable about what that member is going through so that they can make those interactions and solutions offered more powerful for the member.
Now, how does the credit union staff interact with Sentinel?
So the way that a credit union staff member would interact with Sentinel is actually more of a dashboard. So you can actually look at members and take a sense of how are our members stratified by stress score? How are they stratified by changes in income, changes in expenses? And then they can dig into those specific parameters and decide, how do I want to potentially reach out to this member? Is there something that I need to bring to their attention so that they can actually stay on the path that they'd like to stay to? The classic example that I'd like to bring up is if someone gets sick and they miss a few days of work, now their paycheck is lighter than it normally is. Now they've got bills that are going to look a little bit different at the end of the month. If you can reach out to that member the week before their loan payment is due with skip a pay that they're eligible for, now they've solved their solution without
Right.
needing to spend any extra money. But if that member finds out about skip a pay 2 weeks after they miss their loan payment, not only can't they use skip a pay now, but they're ineligible for skip a pay for the next 12 months because that's the way skip a pay eligibility works. That's really what Sentinel is all about, is it's trying to surface solutions for members when they can actually use them and not after the fact. It allows credit unions to be proactive, not reactive to their members' financial lives.
So we talked about the underwriting criteria. You talked about, so using cash flow. These folks won't have a credit score. Can you help us a little bit? Can you help us understand? So what are you considering when you look? What are some of the key parameters you're looking at to look at creditworthiness? Because I always say, look, there's two parts of this process for us, right? As people who lend, right? One is someone's willingness to pay. The other is someone's ability to pay, right? And typically their willingness to pay is I look at their credit score, right, to see how they've paid in the past, and their ability to pay. I'm looking at their economic capabilities, right? I'm looking at their cash flow. So, what are some of the things you're pulling out of the data? If a client's asking you, okay, if you're not using credit score, what does that scorecard look like?
Yeah, absolutely. And so for a credit union that has members that have direct deposit relationships with the credit union, there's a wealth of information that you can take out of that. And that's what our model leverages. And the example that I like to give is you can have two people that are asking for a microloan. They may both have a 620 credit score. When you look at the underlying transaction data of member one, they consistently earn more than they spend. They are saving a little bit of money every month,
Mhm.
except for the last 30 days, where there was a drop in income that was unusual or a spike in expenses that was unusual. That person's ability and willingness to repay may look different than member two, who has that same 620, but you can see in their transaction data, they are consistently spending more money than they earn, and it's more of a melting ice cube kind of situation. Those two people may look the same by their credit score, but their transaction data is going to tell a very different story. And that's an example of kind of how cash flow underwriting can surface credit worthiness using non-traditional data.
So I'm sure one of the biggest hurdles that you encounter in talking to credit unions is performance. So what do delinquencies look like? I mean, if I go back and in doing research for this podcast, look, I sort of predate you and my history, my corporate history, and I remember when Grameen launched, right? And the promise, and I think the actual delivery of Grameen was this 95% repayment rates, and it was all about solidarity, right? It's what credit unions were actually based on, that this concept that if the borrower has agency, if they control the governance structure, that they're going to perform better. Is that part of A, what do delinquencies look like? And B, is this part of your vision at some point?
No, it is the question, frankly, for microloans is how are these going to perform? And it's why we're so proud of the platform that we've built. So we have done about lenders through our platform have made about 14,500 loans on a fully automated basis. That represents a little over 2.5, $2.6 million in notional loan volume. And what we have found is, again, going back to our original foundational testing, what we found is if you underwrite people and just look at 620 to 660 credit scores, they're going to charge off. And let's talk about what a loan officer is going to care about at the end of the day. They're going to charge off at about a 27% rate, which is not an economically sustainable program, no matter how you slice it. With Salus models, you can actually generate at the lowest risk tier a realized 3% charge-off rate. So that's about a 90% reduction in charge-off rates.
Hmm.
Now, that spans our fintech and credit union customers. What we have found anecdotally in our data is that that credit union member connection to their credit union does actually result in higher repayment rates. And so what that does for the credit union is they can say, I know I'm not going to have a 25% charge off rate, and I get to choose. Do I want a 5% charge off rate, a 3% charge off rate? Do I want to have more reach with this program? We've seen some credit unions that are actually comfortable going up to a 10% charge off rate for these types of loans because they're motivated by more than just the charge off rate, but reach and impact for these loans in their community.
Makes sense. So let's talk about the revenue model going forward. How do you see this revenue model evolving for a credit union? Is it all about upsell, cross-sell? Because you're talking about making a member for life, right? Out of this product. So how does it work?
The way that I would think about this is, and this may come as a shock, but microloans are not designed to be a prime moneymaker for your credit union. And the reason that I say that is you're never going to have enough notional loan volume out of microloans to drive your P&L up or down. It's just not a big enough number relative to mortgage loans, auto loans, personal loans. What it is designed to do is 88% of microloan borrowers are millennials and Gen Z. The median borrower age is 29.
Right.
If you want to attract those types of members, to bring them into your credit union, to get that direct deposit relationship, you need to bring them the product that they want to use in the marketplace. And we know that they want to use this product in the marketplace. And I'll give you two Dodd-Frank examples. Chime and Dave. They both offer MyPay, which is early access to paychecks. They offer extra cash advances. They have grown in the last 2 years by 7 million members. That is the same amount as the entire credit union industry has grown combined over that same time period. And those members are 75% Gen Z and millennial. What's the major difference between these two product offerings? One is offering something that younger members clearly want to use and need to use, and one is still developing that product offering. So the lifetime value proposition is if you want to get Gen Z and millennial members down the line for your auto loan and your mortgage loan, you can try to rate compete 10 years from now with every bank, or you can actually give them the service they want right now and turn them into a member for life because now you're going to be the first person they call when they're ready for the milestone of an auto loan or a mortgage loan or the next phase of what they need.
Yeah, great story. Great story, good product. Do you see yourself getting out in the front of the credit unions to help them acquire members at some point through the product or not?
No, that's absolutely what earned wage access is about. Because with earned wage access, you don't need 3 to 6 months of account history to analyze in order to
Right.
see if someone's eligible for a microloan. And the data is showing us, we go to the App Store and look at the top 100 apps. Earned wage access is a real solution that people use every day. And so, because earned wage access only requires 1 or 2 paychecks to be direct deposited into the credit union, it does two things. First, it allows them to acquire members because we can say to a prospective member as a credit union, we can give you access to earned wage access in a couple of weeks from signing up. And the credit union gets the direct deposit
Yeah.
relationship right off the bat, which is what they're looking for anyway.
I think that product, right, given where credit unions are with chasing deposits right now, and every financial institution is chasing deposits in some way. That is a great marketing tool to acquire a new member and to become that sort of direct deposit taker, right, which is the bread and butter, right, for many of these community-based financial institutions.
Oh, absolutely. We've got a credit union that we've been working with. When they started offering microloans, a year after someone has gotten a microloan from this credit union, 65% of microloan borrowers have higher deposits at the credit union a year after they get a microloan. And for Gen Zs, 90% of
Right.
microloan borrowers have higher deposits at the credit union a year after they got their microloan. So
Yeah.
in terms of deepening the relationship, it's turning into a bit of a no-brainer from a data perspective. Yeah.
So what's the future for Salus? What's in the product pipeline?
Yeah, so we have got some really interesting things around the product pipeline, and it really stems from what I just talked about. You want to create a member for life. So a member for life means that you're there for all of the milestones that they have. So you start with something like microloans or earned wage access, where you're helping somebody deal with small financial emergencies. But what do we all want in our 20s and 30s? We want our car, we want our first house, we want the American dream of home ownership. That only comes through a traditional credit score. So we are actually working on the product roadmap right now for products that not just help someone with short-term financial emergencies, but build them a path that gets their traditional credit score to where banks and credit unions are more than willing to say, we'll give you that all loan, we'll give you that mortgage loan, because that is the lifetime member value proposition. And I would say this, Gen Zs and millennials, they are 2 to 3 times more likely to want an auto or mortgage loan in the next 5 years relative to Gen Xers and baby boomers. The demand is there, and the race is on to basically compete for these members now, give them what they want so that they stick with you for years in the future.
It's great. Well, a great conversation, James. Thank you for joining the podcast.
Yeah.
That's a wrap to this episode, 22 Minutes in Lending. And to our listeners, thanks for tuning in, and be sure to subscribe, share, and join us for our next episode. Thanks again, James.
No, thanks for having me, Vince. Appreciate it.
Awesome.
Thank you for listening to the 22 Minutes in Lending podcast. We hope you enjoyed today's episode. You'll find links to any resources mentioned in the show notes. If you're enjoying our show, be sure to subscribe and leave us a 5-star review.